Good morning, everybody. Welcome to the Flow Show, Friday, the 11th of July. We got it to the end of the week. Well, nearly got to the end of the week. And it's Friday anyway. The sun's out. It's boiling hot. I'm sweating me cods off. So I better switch the fan off. Otherwise, you'll hear a load of racket on my mic. Morning, Kate. How's it going?
Morning, Ryan. Morning, everybody. Yeah, going pretty all right, mate. Glad it's Friday. Then we made it again. And yeah, ready for the weekend, especially.
Yeah, absolutely. Going to be a scorcher of a weekend. I've got. You hitting the beach at all, mate?
No, I'm going to see my younger one in Bath tomorrow.
Nice.
Then on Sunday, I guess I need to do the lawn and perhaps some other stuff. So no, tomorrow I'm off to Bath, mate.
Yeah. I'm hitting the garden tomorrow, do some jobs, and then I'm hitting the beach and spend the weekend down there. I might even sleep down there if it's that hot. Right. Anyway, long way to go before we get to the weekend. Let's go over what's been going on. Going to start with the data, and the data this morning was good news for the UK after proudly proclaiming the Q1 figures. The UK being the strongest growing country, fastest growing country in the G7. We're now the fifth fastest growing country in the G7. So, it all went backwards. We knew it was going backwards. We all thought that Q1 data was a bit of a tariff trade front run, and it's been given up slowly but surely since then. GDP on the month. Last month was down 0.3%, as expected to rise 0.1%. It came in down 0.1% year on year. It dropped as expected to 0.7%. The rolling 3-month figure, so this is like a rolling quarterly number, is now at 0.5%, which was a little bit better than a 0.4 expected, but down from that Q1 number of 0.7%. Now, it doesn't mean the economy's falling off a cliff or anything like that, but just as mentioned, we knew there was going to be some give back in those strong Q1 numbers, and this is it. And whether June is going to be just as bad or can save her skin, who knows? But the economy slipping backwards is going to put pressure on her anyway. Trade balance data out as well, and a little bit of an improvement over the deficit from last month, though not as much as expected. We've got some price data out from Germany. Wholesale prices, they ticked up quite a bit, 0.9% year on year, up 0.2% as expected month on month. So we'll have to see if all this German spending is going to do anything for prices as well. ECB's Schnabel says the bar for another rate cut is very high. ECB's Pancetta says the ECB should cut more if weak growth weighs on prices. Says the monetary policy approach in the coming months must remain flexible and pragmatic. Bit of data. Well, I'll ask UK first before we go back to look at the other stuff. Those UK numbers, as we expected, not much of a move in the quid. But the sign of things to come.
Sorry, I'm just killing my squawk. Hang on. Slippery slope, Ryan, and then with in mind Reeves and her fiscal issues, I'm thinking it's not really good for sterling right now.
Yeah, not very good indeed. I'm still looking. I know you've already dipped into euro sterling.
Yeah.
I've been holding off a bit to see if we get a dip on any trade stuff, but it doesn't look like we're getting anything better than 86 at the moment. So I might have to join you in tacking on a little bit just to have a piece of pie on the plate, so to speak.
Yeah, but on the other hand, we are still stubbornly capped at 30.35. That's been tried a fair number of times now, and it's not breaking through. This is the level that's going to have to break, and we've already looked at that. If we go there, I think then we can probably grind higher. But as we've seen again, sorry. Oh yeah, maybe I should have waited. But as we've seen already, it's a slow market, and it's one of those granddad traits. if it's going to push higher, it's likely not going to be an explosive one. It's one where we will have to be patient and let it play out in its own time.
Yeah, it's not been for Euro sterling. It's been quite a rapid move, and we've had a couple of them this
The
year.
first ones, yeah.
Yeah, and even this one is quite rapid for Euro sterling, even though it took 2 and a bit months to do it, but that's still a hefty amount anyway. But yeah, moving on. So yeah, data yesterday, it hasn't been a lot out, but we had jobless claims coming out, which was nothing of note. Jobless claims coming in lower, although continuing claims did tick up over last week, but not as much as expected. But we're still hovering at levels that no one needs to ring any alarm bells over. We've had a few Fed heads out, and the main thing, as we mentioned yesterday, that we're going to be watching from these Fed heads from now on is to see which side of the fence they are going to plonk themselves on. If they do, are they going to go towards a more dovish side and a more Trump side, or are they going to stay with Powell? Fed's Muslim said the economy is in a good place with the labour market at or near full employment. There have been some positive trends on inflation in recent months, but the outlook is for it to increase going forward due to tariffs. He says dollar weakening could add to inflation, but not much comment on monetary policy stance. Fed's Waller in the frame to replace Powell hasn't been shy in giving his view. He was talking about other things as well. Said the balance sheet may not need to shrink as much as some expect, and that the Fed should consider shifting holdings more towards Treasury bills over time. Says he has been arguing that a pretty restrictive policy rate can come down. Says tariff increases prices one time and central banks can look through that. Reiterates the case for why he thinks a July rate cut could happen, but he says an easing would not be political. Sounding a bit like Pinocchio there. It says the Fed is too tight and can consider cutting in July. We then had Fed's daily out, and well, a little bit fence sitting, a little bit not fence sitting, certainly sounding a touch more dovish. Started saying monetary policy is still restrictive and that it's time to think about adjusting the interest rate. It says in economic fundamentals support a move towards lower rates at some point, but is thinking about rate cuts during the fall or the autumn, which particularly would rule out July. It says to cut rates, we need a continuation of current data trends. And waiting for inflation to rise could leave the Fed behind on cutting rates. Doesn't expect very persistent inflation impacts from tariffs. Says the labour market is cooling and growth is moderating, but the data is not getting meaningfully weaker. Kate Daly, we were on the lookout for her. Not really falling on completely onto Trump's side, but not. She's willing to pay lip service to that side of things.
Yeah. Exactly what we were saying yesterday. Now we have to see what the others are going to say. She's I'm not going to say in Powell's camp. She's pretty neutral. She's where the dots are, I think. Yeah, to rate cuts.
Yeah, and that was a repeat on her call for an autumn cut, by the way. So it's not.
Yeah. So I mean, neutral there, I would say from her. It's a bit both sides of the ale again. We are approaching the cuts, but did she completely rule out July? I don't know, but if she says autumn, yeah, then we're probably looking at September.
Yeah. I've just looked back over her prior comments, and several times she said about autumn. It would be a push to get a July cut out of her, I think. But you never know. You never know.
The thing is, though, exactly, is that the next set of data can all of a sudden get her over the line and also vote in July. And next week, right, we have the inflation data in the US. Imagine that we get a surprise lower number. She may be one of those who flips.
Yeah, but expectations are that we see, I think, the highest inflation number since January. I've seen some shouts for that. So yeah, that's going to be a very big number next week. But that's for next week. Right, Hassett. He was having a little bit of dig at the Fed. Said they haven't explained their reasons for prior policy errors. Says the current Fed is not independent, and that the new Fed head should take a close look at the size of the Fed. That was some pretty strong calls or some pretty strong comments on the Fed. This really is, or really could be, if it hasn't already, going to become a big issue. Because if the one thing that the Fed has, whether you believe it or not, is independence. And even when Trump came in first time around, yes, he was moaning and groaning, but he still left them alone to do their job. If there is any signs of big tinkering at the Fed from whoever comes in, that they're going to change things around and push things more towards how Trump would like it, I think the market is going to take a very dour note of that, because you need to leave the Fed alone. They're the second biggest central bank in the world, huge, as you know, and anything that potentially makes them a bit of a puppet, I don't think the market's going to like one bit whatsoever. So this is the sort of stuff we're going to need to keep an eye on going into the latter part of the year. Right, on the trade stuff, Trump decided that he was going to throw some letters around. He decided he wanted to hit Canada with 35% tariffs, although there's apparently going to be an exemption for USMCA goods. So this letter is going out to Canada. The EU is apparently going to be getting one. They could get it today. But it was important to see the price reaction over that. Obviously, the algos jumped all over it. We saw dollar CAD getting a little jump up into the 137s. That hasn't lasted, and we're sort of back below 137 and messing around. Euro took a little bit of a knock as well. None of this is big moves in the grand scheme of things. We've seen far bigger in the old deadlines. So the market pretty much taking it in its stride. I think as far as the euro is concerned, unless Trump sends a letter and the EU gets the ump, turns around and says, right, well, we're going to reciprocate and negotiations are off, I don't think the market's going to pay too much attention to any further letter threats. So it won't be the letter, it'll be the reaction, because they're still negotiating. That's still going on. Excuse me. That could go on to the 1st of August, if not solved before that. Okay, we're in that situation again. The bark is worse than the bite now for the market.
Well, he's still barking and potentially biting, but the market is starting to get used to be barked at. And that, I think, is what and what we so often say, right? The market trades and then fades. I'm not saying fading the moves, but yeah, we actually see fading of the move. But then the impact of stuff is always the biggest the first couple of times, and then the market starts to get used to it and really wants something now to stick their teeth in, not letters, but if you imagine you're a big money manager, and now a lot of those are modeled. They're using models for everything. I'm not saying algos, but models to model the whole economy or whatever. So they will by now have some sort of an idea about what 10, 15, 20% tariffs may mean from one to the other country. It may also mean on the other side in receivables into the US coffers and stuff. And now they are waiting for numbers to update their models, and I think that's where we are at now. Yeah, brand the catalyst, but the catalyst is we as retailers sometimes look for too big of a catalyst out of something too small, and that's why I like to repeat that, because we are just like that small percentage of the market. Whatever we think is going to be decided by the big money managers, if they get what they want, that is certainty about numbers, then we are probably going to see the next reaction in the market about on the back of those tariffs, trade deals, and what it means in monetary terms, really. Who is going to have to pay and who is going to receive money on the back of it?
Yeah, absolutely. Absolutely. So I guess today we could get something, could get some letters, could get some other news,
Yeah,
and then we'll see where we want to get. But it slowly looks like the market is getting over this hump. And as I said on Face yesterday, we may be heading towards summer markets, given some of the price
yeah.
action we got yesterday. Or who knows, or we just get over this hump and the market gets back to flogging the dollar and doing what it was before.
Yeah.
But maybe even in that sense, that trade might, these flows don't all keep going, day after day after day after day, month after month. There will be pauses, there will be stops where the market takes a little breather. So who knows?
And I think we are in one right now, Ryan. We
Yeah,
are in one. Because that also showed yesterday when we had that blip on yeah, you showed here the dollar cat, but we can talk about the euro dollar as well. We had that move under 116.80, and it was supposed to be the start of a bigger dollar correction, and we are back at 116.90, and well, yeah, here we are. I mean, that's what I was saying. Like, I'm not sure that the big players are actually part of what's happening right now, and then you see the market gradually crawling back or stabilizing. In the bigger scheme of things, we're at 117. We're not at 115 or 114, and we are not at 120. We're at 117. We're somewhere in the middle. The big money has done probably a fair bit of what they need to do, and now they wait for what's to do next. And yeah, that's yesterday, as I said, we it could have translated in a bigger move in the euro dollar if really the market thinks that it's time to buy dollars. We would have seen a bigger move, right? And
yeah,
but it's still shorter term hedge fund stuff. Probably a round of stops there below 116.80 and things. I tried to be long. I took what is it, 30 pips in my face as well. I mean, but I wasn't too bothered about it. Because I'm interested in also seeing what's going to happen next. It's just part and parcel of trading, as we have already said so often. Yeah. Um, but I'm really interested in seeing what happens next. And what is happening next is a very quiet market. Yeah.
yeah, yeah, very much so. And that, like you say, big money isn't trading 30 pip ranges in euro dollar.
No.
But we are. So yeah, we'll be hitting the levels and trying the levels and whatever, and might lose a bit or whatever. But we keep in mind what the trend has been overall, which has been a significant uptrend this whole year. Okay, that isn't changing. Whatever you're doing, 30, 40, 50 pip ranges day intraday doesn't change the overall trend. But then, when we talk about money exiting the US, it doesn't mean big funds are saying we want zero US exposure. They're just reducing how much exposure they give. So if they allocate 50% of their assets to the US, they might say, well, we're going to bring that down to 35%. Doesn't sound a lot in those terms, but in monetary terms, it is a lot. And that's what drives markets. So it's not everyone's going, we're getting out of the US altogether. It's just we're going to reduce our risk to the US. And whether that grows or abates is going to define what happens to currencies like euro dollar, whether they keep going or whether they find a bit of a top or a bit of a pause going in. So big money doesn't think like you or I do in most of the times when it comes to trading. Right, Lutnick is he's missing out on air miles, so he's going to Japan next week. He'll be looking to do some trade talks, it seems, given his role in the US administration. OPEC Plus, unsurprisingly, are discussing pausing their output hikes from October. They've been ramping up their production numbers for the last couple of meetings, couple of months. It was always going to come to a halt at some point, but they've circled October as when that may be, according to sources. So bear that in mind. We got a bit of Russian stuff going on. The Kremlin was apparently asked if they thought the peace process on Ukraine had stalled, and they said they don't think so. Zelensky was out not long after that, saying Putin has rejected every peace proposal. Secretary of State Rubio, US Secretary of State Rubio, was out speaking to his counterparts in Russia and saying that stronger sanctions on Russia is an available option. And apparently Trump is planning a major Russia statement for Monday. That's according to Bloomberg. Europe are as well ramping up possible sanctions, more oil price cap moves, armaments to Ukraine. So if we're sliding out of the trade tariff news zone, we might be sliding back into that Ukraine-Russia risk zone, because the market always wants to know what it's going to trade next. So keep an eye on those headlines. Go on, mate.
Right, I've got a question for you there, because we've seen Russia ramping up the sending of drones into Ukraine. Then now Trump has agreed to send more weapons again to Ukraine as well. What could it be that he announces on Monday? I mean, do we need to prepare for something really bad here, or because I was thinking about that. I mean, the combination of both, because we've seen the biggest attacks in months, Russia into Ukraine, yeah, and onto Kiev.
Yeah.
Do we need to prepare for something really, really hard or so?
I mean, with Trump, you can never rule out what he's going to say. But given what the noises have been coming out of the US, it has all been about harsher sanctions. So he's probably going to officially do one of his executive order things or whatever, and throw a load of tariffs on. But, we've got him looking to provide more defense systems to Ukraine. We've got the Germans looking to buy defense systems off the US to give to the Ukraine. We've had Macron, the busybody, coming over and getting busy about defense with Starmer, and everyone's been out saying they're going to give more aid. The EU apparently have found another 2.3 billion under the sofa to give to Ukraine. So it feels like this is all ramping up a bit. But yeah, I don't know what Trump's going to do if we knew that.
Yeah,
but I think it's going to be tariffs. Sanctions, probably tariffs as well. But and probably maybe something on what armaments they're going to be sending over. Who knows? So there's probably is a bit of a risk there, as you say.
Okay. The risk should be after the weekend for us, because I mean, if it's a Trump announcement, it's probably going to be in our afternoon on Monday. But it is something that perhaps we should not completely dismiss as market traders.
Yeah, absolutely, 100% agree with that. Right, that's it on the news front. Anything else, Kate?
Oh no, mate. No. No, there's not a lot else going on now. We've spoken about everything, mate.
Yeah. So I wonder what we do now. Well, we did have a bit of a discussion yesterday on trading and emotions and that sort of thing. I've been having a chat with one of our roomies today about, and was talking about euro sterling and how they've been buying at sort of 86.10, getting out for a little bit, and on the back of you getting in at 24, was wondering whether they should have stayed in the trade or added like you had. There's two things to note when you're in a community like ours, or you're looking at anyone else's analysis or how they're trading and whatever. You can't let it influence your own plans. Okay, if you had a plan to do something, enter a trade, exit a trade, and you fulfill that, then you're doing well. You're executing your plan. You're following your plan. You kind of regrets over your plan. But if you're wondering, hey, I'm exiting my trade here, but someone else is getting in the trade there, you're thinking, why are they doing that? And then the price moves that way or whatever. What you need to do from that is say, well, why did I exit out my trade where I did? If it was my plan, that's great. But if I keep doing that plan and I keep seeing the market continuing to move my way, what do I need to do to adjust to that, to potentially increase my profits? And it goes back to the old trading strategy. Well, is old now, okay? Is the slice and dice. And I told this person, and I'll give the same advice to everyone here. It's a good exercise if you split your trade up. Okay, if you trade normally, and Ali, you're the perfect example of this. I don't know if he's here today. I don't think so. But Ali's a perfect example of this, where he gets in a trade, he gets out, takes his profit, and then the market keeps moving. Split a trade up. You can go two halves of what you were going to risk. You can go 2/3 and a third, 3/4 and a quarter, however you want to do it. Play your trade as you would normally, but keep the little bit, the other half, the other quarter, the other third, keep it on and see where it goes. Okay. And then you get to actually see it in physical form, in pounds, pence, dollars, shillings, denarii, whatever. You get to see it in real terms. What would happen if you let that trade run? And if it kept going your way, could you take 5 pips, 10 pips, 15 pips, 20 more pips? Okay. You haven't spoilt your original trade. You haven't increased your risk, but you'll be able to see in real time what happens if you kept a little bit on instead of taking everything off at that profit target. And you see 10 trades, you made more, 5 trades, you lost more, or gave the money back. And you use that process to assess your trading and to work out how you can improve your trading. You know, we keep saying it, slice and dice. I don't give up a winning trade. There's a reason I don't do that, is because the trade could do more. And as long as I've got my risk as low as possible, to zero if possible, then the outcome's pretty clear. There's only 3 outcomes in trading. You lose money, you break even or don't lose, or you make money. If you get your risk to zero, the only 2 outcomes are you don't make money or you make money. The loss is gone. It's finished. You can't lose. Okay. So from that point, then you want to improve on your winners. So I'm going to give you all homework. Okay. If you find that you're getting out of trades and finding that they're moving on afterwards, then don't get out of all the trade. Leave a little bit on and see what it does and manage it. So it gives you something to do. Move your stops up, move your profit targets, try and play the trade a bit longer and see what it does. And if you find that that's improving your profit margins regularly, then you can apply that to your whole trade. And then maybe you only take little bits off and you do the slice and dice on the trade and try and get a bit more out of a winning trade. Kay, I know you're going to echo those thoughts. Well, pretty much the same.
Well, no, it's really good. But everybody has also different reasons for entering in a trade. It's not because myself or Ryan we're entering a trade and you're already in something that how shall I say that you start to question yourself because Ryan or myself do something, then you should ask the question why maybe we enter a position. Usually we give the reasons because we talk about something, like for instance, the euro sterling, we have been talking about it for days. I was trying to get in low 86s, never got it. Sorry, excuse me for that. But it's also, when you have a plan, it's not because whoever is saying something that your plan has to change as well. But I think what Ryan just said then comes as a very nice addition to what your plan is. I mean, you don't have to change your plan, but you add it to the plan. So yes, your plan is going to evolve a little bit, but you don't specifically have to change it. If you're long euro sterling, let's say, at 86.15 and it goes up to 86.30, and it's been where we are again now, and it's been capped all the time. If your plan is to take profits, but then in the additional thing, the addition to your plan is perhaps don't take your full profits and then see what's going on. By the way, I mean Ryan or myself, we are not trading gods, you know. We hit it more right than wrong because of experience and because of the studies and stuff that we do, but we have been wrong as well in our life. So no, but it's that we all have our different trading approaches as well, okay? And that's why I'm saying it's not because I know myself we say something that that it's going to be the right play to do. If it puts your plan in doubt, then ask us why it can put your own plan in doubt. If your plan is purely technical, maybe there's something in the fundamentals that is going to have your plan adapted. And that's where then we come back to slice and dice. I mean, I've been doing it all my life. Riley has been doing it for many, many years as well, because it's the best thing to either remain in a position or for as long as the fundamentals don't change against your opinion, right? So yeah, I mean, it's just perhaps an add-on to your plan, but if your plan has been working for um, years and you've always been making money on the back of it, I mean, just take it as an addition to what your plan may be, and your plan may always evolve. I mean, our plans evolve constantly as well, because we can uh, because the fundamentals most of the time price action obviously as well, but the fundamentals need to change for us to change a plan basically. But I know a lot of retail traders are pure technicals. I would advise you, for those who are technicals only, to start looking at fundamentals, because they can help your plan really. And that's what I just would like to say. I mean, as I said, usually we talk about the plans and about the way we look at currencies in general and in particular some currencies. So we can always, you should be knowing, if you are in our community, you should be knowing um, already why we sometimes do things that there are. Like for instance, today it's relatively simple. I was looking for levels to enter in the euro sterling, but the data in the UK have just pushed me over the edge, and I've started along now again. By the way, we just passed the top of the hour, and it looks to me that that run in euro sterling was perhaps a bit of a fixing, the 11 o'clock fixing in the UK. Just these to add to the euro sterling fund.
Yeah, maybe we're maybe we're doing the old boober trade again, mate. You
Mm,
remember that one? Um, but yeah, it's you know the wrong question perhaps is if you're looking at other people, why are they getting in where I'm getting out? That's not the question to ask. The question to ask yourself is, why did I take profit there? Why am I taking profit there? And that can be the key to your trading. If you didn't take all the profit there, what did the trade do after that? If you don't want to put a trade on and split a trade or do anything like that, fine. Write it down on a bit of paper. Do it on a demo account, whatever. Just do something that you can see what would happen. Right. Good advice as always, mate. Thank you very much for that. We're in euro sterling, so I might as well stay there. We are stuck in this thing. Yes, we have got this resistance coming in around the 36s, which is just ahead of my zone, a few pips above that, so probably all part and parcel of that. We tapped the top of that. We're now holding the bottom of that. It needs to get through this zone before it's going to truck on higher. But we are limited to the low 86s with the odd minor blip underneath. So 85.90 is going to be a bit of a level, but as with this pair, we got levels probably every 20 pips down and up. I don't know. I might, again, we've both got a strategy to get long euro sterling, so we're short the quid. We would like better levels, but if we have to jump in at market, then we do so with a smaller position in case we are wrong in this timing and it does pull back. It just gives you a bit of piece of the pie. If it doesn't dip back and you get a better entry, then at least you got something on, and then you have to work out whether you want to add on breaks and that sort of thing. So just because we might be chasing the market a bit doesn't mean we go all in on our trade and risk just on that one trade. There's no FOMO about that. Right, what else? Looked at euro sterling, dollar yen. That's having a little knock up at 147. We've played this game before. Here we are again. We're finding struggling into that, call it 147, 15, 20-ish level. We've had a couple of little nibbles up there. Can't get through. But this is a fairly decent bounce off of a retrace after that first test. So it could mean we're going to be moving higher. Got a similar thing here, a little pullback, and then we shot on through that level there. So it's looking pretty similar. Could mean we get run up to the 148s. There is still no reason to be long the yen for anything other than short term at the moment. I saw Mark was asking, is there still a big dollar yen carry trade to unwind? It's a difficult question. The carry is obviously still there, but when you've got volatility like this and you've got 5, 6, 7% moves, it sort of negates the carry trade for the FX risk side of things.
Yeah, because whatever carry there is can be undone over the next session or so. Well, this time I don't know whether you know what? I think there is still a part of this market who does trade some form of a carry trade. I do think right now, though, that the reason why yen is weakening is not the carry trade. It is the fact that Bank of Japan looks a bit trapped to hike faster sooner. And at the same time, Japan can't get a trade deal with the US done. And that is rather what is weighing on the yen right now than too many carry trade. Well, I mean, we've I think Blake looked at it. The Mex yen is trading at very lofty levels again. There may be some carry trade there. I mean, in the very high yielders, but I wouldn't qualify dollar yen, euro yen, the rest of the majors yen as a yeah. We are back at levels where we were end of 2024, where everything was looking a bit rosier for the carry trade there in the mixed yen. But I would say that there probably not too much of a carry trade going on in stuff like euro yen, for instance, because the euro has ECB has cut rates already. Sterling yen is still higher rates, but there we are perhaps a bit struggling with the fiscal and growth side in the UK. Another one, and those may be perhaps a little better, or is the Aussie yen. We know that Mrs. Watanabe and sons and nephews, they like to do Aussie yen. It's actually the second biggest currency they trade after the dollar yen over there, and that may be one that is enjoying a bit of carry trade there again. But I wouldn't this is not the carry trade that we had, or in times of everything is zooming on quietly. We've got the Abenomics in place. We've got economies around the rest of the world who are doing pretty okay. And like your quiet carry trade, where interest rates in Japan are zero, and the rest of the world is kind of zooming on without big geopolitical risk and or at least imminent, or also it's not that kind of carry trade that's going on right now. There may still be people looking for returns on the carry, and if you look at MEX yen, MEX is still at 8%, for instance. That may be one. The Aussie kept the RBA kept their rate their hand still. That Aussie is doing pretty well right now as well. So there may be a part of carry trade still ongoing, but as I also, sorry, said, and we have been talking about it, get all of a sudden a US-Japan trade deal, which is not looking too bad for Japan, yen is going to strengthen 3, 4, 5% in the immediate aftermath.
Yeah, and you also need to remember that people think about a carry trade. Oh, they just buy a currency and sit in it. Okay, well if people were buying into because remember rates were only coming up, in this period, rates were still fairly low. 2020 is coming out of COVID and everything. It's only the inflation spike that saw inflation rates giving that carry trade. So if you were buying dollar yen for a carry and you were getting up to 162s, you've made 10 times as much on the FX trade as you are on a carry. All you're doing for a lot of carry traders, unless it's a big one like MEX, is that you're on the right side. You're not bleeding money while you're sitting in a position. You're earning money while you're sitting in a position. But if you're trading dollar yen and you long at 130s and it's at 160s, you're making more money on the FX trade than you are on the carry. And you're not going to say, "Oh, I'm not going to take that profit because I'd rather earn the 4% interest." So it's not as simple as saying a carry trade is earn the income and stick it in a drawer, especially when you've got this sort of volatility going on. So I hope that's cleared that up for you, Mark. Kate, I'm going to ping it over to you, mate, because we're rambling on today.
By the way, I'm in agreement on. Whoops, hang on a minute. Can you see my screen?
It's coming. Not yes, there we go.
Okay. I'm in agreement, by the way, on the dollar yen buy, and I think there is a chance we go for a little bit of a pop there. Yeah, you were asking about silver and gold. Yes, we are trying to break up again in silver here. It's actually already going quite a bit. As I said, I've been just banging on about this for as long as we're above this green zone here, and even stretch it to 34.85. It's looking very big, and it is still very big, and it is still outperforming gold right now. There is a possibility we are going to hit that one 161.8. And let me just look. Am I looking at? Oh yeah, it's on the dailies as well, so I can move over a little bit on a wider scheme. So 38, call it 38 and a half. That's on the cards right now. We are not yet ready, I don't think so at least, to go and have a look at 40s. But the longer term, we're actually around the level right here. This 37 and a half is going back all the way to 2012. Now, people always look at those things. Oh, this is 2012 high. It should stop here. We're in a completely different environment compared to 13 years ago. But at least the technicals or the technical viewers, they will probably look at this 37 and a half. But if we can, of what we can see on the shorter time frames, we are pushing higher. Okay. And here you can see perfectly that 35, 35, 34, 85, 35 and a quarter. That does go back to those old days, and it was the 61.8 as well of that move. So, and we are really pushing through. Can we get up to the 40s? Yeah, why not? There's several reasons actually. What I think personally why silver is pushing on. First of all, we were talking about the market getting a bit used or so to those Trump and to the tariffs and stuff like that. So there is probably a bit of shortage in silver as well for the. Sadly enough, we have to say that if you send an army of drones out left, right, and center, you need to replenish the stocks, and silver is one of those metals that's used in building drones as well. So wars create some kind of demand for this as well. But even so, it is outperforming. It is outperforming gold. I think the gold-silver ratio has something to do with it. But also the technicals are just still very, very big for this. So on the day, I would say keep an eye on what's happening. Low 37s now, around let's say 37, 15, 20. That should be your first support. Yes, the prior high 37.30 may show up, but I'd rather look at this one because it's silver. It can move relatively rapidly. If we get back down, I just think more consolidation. But again, longer term above here 35s, it's still extremely bullish in my opinion. Gold, yes, broken a bit of a trend line. People were watching it around 33 and a quarter. I think that's going to be our pivot of the day. And now we are trying to test uh, to those highs that we saw over the past week or so. This is last Friday high 33.45. Our Monday high 33.45, and now we are trying to get back there. So this has to go for moving back up into the 33 three quarters. This is, and it's been resilient, right? It has been resilient. I really thought that there was a chance at one stage to break this red trend line and go for a little bit of a walk down, since the market was waiting and perhaps not wanting to put all those hedges up against all things bad in this world, but it's been extremely resilient, and now it's starting to push up again. So intraday, short term, 33 and a quarter. That's what's the market is going to look at, and obviously 32, 85, 95 if we would get something more easy or better in the market. The thing is, and what's happening here? Do you guys still hear us? Hear me?
Yep, got
Oh,
you
okay.
okay.
Now, the thing is, maybe this is a bit of a reaction as well to what we've been talking about, and that is what's Trump going to do versus Russia. So maybe this gold could push a bit higher just because of the risk factor that we have, not per se over the weekend, but right after. So people will again maybe not want to be short in this one, but yeah, so there is a risk that this pushes a bit higher going into the weekend. That is it. Yeah, just the Aussie. I just want to show a couple of things in the Aussie because we were looking at this in our room yesterday. We had this big break of 179 in the Euro Aussie, and we actually dropped quite severely, a percent. It dropped like a percent, really, over the course of the afternoon, the evening, and the night. But we just hold this trend line here this morning, okay? And that comes in around 177, give and take 15.25, okay? That's one that is interesting to look at. And as I said, we may consolidate a little bit, which is exactly what we are doing now. But watch out if that thing breaks. That's probably going to be a relatively risk positive move if it breaks down. But we have to say that Aussie is really doing very well versus a lot of currencies. One, of course, sterling losing its appeal over the past days is this sterling Aussie coming gradually down. And yesterday and overnight, we broke through this 206.60, which was not only trend line but also horizontal support, and we are trading quite a bit lower. This, unless sterling stands up, which is not my preferred side for the moment. This has the potential to go at least 204.80, but why not have a look at these levels here around 203? This is very much possible, and that's the reason. And then I'm going to stop it there. That's the reason why Aussie is now gradually pushing up. Is not so much a dollar, but yesterday it was very clear that the Aussie dollar didn't want to come down. Didn't want to come down a pip when the euro was coming down, sterling was coming down. Aussie did not want to give anything back. I'm a little long in this, but yeah, it's going to need perhaps a stalling dollar or so to continue to push. But we are again closing in on the top end of this wedge or channel, whatever you want to look at it, this upper trend line, 66.05, 66 and a quarter. that's going to be the 66 and a quarter is going to be the confirmation to get up to high 66s or even 67s. The Aussie is quite big, I must say. It has been a laggard for a while, but now the Kiwi is the laggard of the both. Although it's pushing a little now as well. But if unless something dramatic happens on the tariff side or so, or Trump says something bad that Australia has to choose between the US or China, or so, in which case this is going to get a knock. I would not be surprised that this grind continues, and we are going to have a bit of a push there, unless, as I said, the dollar is gaining more and more appeal. But Aussie looking pretty big for the moment, I am going to say. With that, Ryan, back over to you, mate.
Thank you very much. Nuno, you're asking about Bitcoin. What do you want us to say about Bitcoin? All-time highs, where to buy it, where to buy the dip? Buy the dip at the break point. The big break point was 110, 10 and a half-ish. So, yeah, there's not much to say about Bitcoin. It's stretching to all-time highs. Where's it going to top out? Who the hell knows? We've got 120 next. That'll be a big psychological level. But the levels are there if you go looking for them, mate. Right, that's it for this week. Thank you very much, everybody. Thanks, Kay, as always. I hope you had a good week. Please have a safe and peaceful weekend, and we go again next week. Take care, everybody.